Please welcome Professor Rao.
Thank you very much, Sophie. So thank you all for coming today, because I know I have stiff competition. The Trump inauguration is going on as we speak, right? And I was just looking at the news, and it looks like he's making America great again, beginning right now. So, but thank you for coming to this instead of that. Right? I can't even make Britain great again. So, anyway, so today I'm going to talk about insurance markets. Right? So far, this series of lectures have been about the human side of finance. At its core, the idea of finance is very simple. And this is something I've been talking about for a long time. Finance basically involves moving money through time. What that means is you're talking about somebody who's promising to give you a large amount of money in the future in return for you giving them money today. Right? So money today to be paid back at some point in the future. So you're moving equivalent amounts of money through time. Of course, the question which you have to decide as a finance person is, what are these promises worth today? Now, classical part of finance, which does not actually involve human beings, it's just, rational, emotionless, calculating machine, basically says, what's the present value of the promise? And that's what we teach MBAs and, the standard student classes we have. But today, and in these series of lectures, we're going to talk about the human side of finance, because yes, people may calculate the value of the promises properly, but maybe they're lying to you. Maybe they're doing this deliberately. So that's fraud, and we'll talk a little bit about fraud today. But it could also be they're taking advantage of you because it's very tough from you to figure out the value of that contract. So either or, right? So this one case, it's an incomplete contract, and so they're taking advantage of the fact that you have no idea what you're signing, or they're just lying. So today, I'm going to talk about a different form of lying. What is this lying? Here, the lying part comes in because, in this case, the company is not necessarily lying to you. Well, not always, right? I mean, there are cases when the company is lying to you, but here the problem is you might be lying to the company, right? So what does that mean? The company has to price its insurance product, knowing that some of its customers are deliberately lying to them. Right? So it has to figure out who is lying and who's telling the truth when trying to price the insurance product. And so how does it do it? So how does the insurance market work? That's the subject of today's talk. So a lot of these examples here are taken from this book by Anna Finkelstein and Fissman called Risky Business, a very funny book, well worth reading. So if you want to know about insurance markets, that's a great book to start with. Anyway, the key point about these markets is they're what we call selection markets. Non-selection markets, we all know. For example, the NHS. The NHS is a non-selection market. If you're paying taxes in the UK, you're part of the NHS. Right? So there's no thing I choose to be part of the NHS or I choose not to be part of the NHS. I can take additional private insurance, but the NHS itself, everybody can be part of it. Same thing with European healthcare systems. In contrast, selection markets consist of things like life insurance or American health insurance, death insurance, car insurance, gadget insurance. The rest of the insurance markets are found around the world, not just in America, but also in the UK. We have car insurance, we have annuity purchases, pension insurance, all these things. So let's take an example of a selection market. This is something which happened in the news just this week, right? Fires in California. So in LA, you have these huge multi-million-pound dollar houses, all of which have been completely burnt down in places like Pacific Palisades and so on. Unfortunately, most of these houses are underinsured. So I have a friend who lost her house completely, 30 years of possessions gone in Pacific Palisades, and the insurance company will not pay her more than 30% of the value of her house. And now, because of the fires, a lot of insurance companies are saying, I will not provide you insurance at any price. I'm getting out of this market. It's just too dangerous. Even if you want to be insured completely in California, there is no insurance company which will give you insurance. So the internet is full of examples which basically says, well, how do you reduce your risk in this high-risk area? For example, you can build a neighborhood insurance pool, community-based catastrophe insurance, and do-it-yourself safety nets. Most of these will not work, and I'll explain why as we go through. But let's start with a very simple example of a selection market. And that example is based on a woman called Jean Calment. Now, some of you may have heard of her. She died recently. She was the world's oldest woman, and she died at 122 years of age. So this was her. When she was 90, she used to eat more than 2 pounds of chocolate a week, treat her skin with olive oil, rode a bicycle till she was 100, and only quit smoking till at the age of 117. Right? So what does this have to do with an insurance market? Well, it turns out when she was 90 years old, she made a deal with a local lawyer called André-François Raffray. When she was 90 years old, she wrote a contract with this person to say, you know what? You can buy my apartment, but I will continue to live in this apartment till I die. In return, you pay me $400 a month until she died, and then the apartment becomes his. This was when she was 90. 32 years later, it turns out poor Mr. Raffray had died already. He died at 77, and he had already paid her $180,000. His family was still paying when she died. And she said, you know, and sometimes life, one makes bad deals. And this was a terrible deal for Mr. Raffray. But was it really such a terrible deal? I mean, you wouldn't think a 90-year-old can live till 122, right? Well, there is an alternative story. What is that story? It turns out an alternative story was actually she had died when she was 55, but was actually replaced by her daughter. This was a point in time when she was basically, apparently, the idea was that she died in 1934, but her daughter Yvonne took over her identity to avoid inheritance taxes and pretended to be her. So actually, she wasn't 112, she was only 99. So there is some debate of whether poor Mr. Raffray thought he was basically insuring a 90-year-old, but she was only 70 or so. So that is an example of lying, right? But in this case, she's lying to the guy who is writing the contract. Now, this is not proven, right? This is just a hypothesis. But it's an interesting hypothesis. So where did the earliest selection markets come along? There are different types of selection markets. One classic one is the start of what we call annuities. An annuity basically means that you give the company a lump sum. In return, they'll give you an annuity for as long as you live. The second one is a lump sum repaid by a guaranteed annuity. The first one is the value of the annuity, the amount you get, depends on the market. So it could go up, it could go down. The second one, it's guaranteed. You get £1,000 per year or per month till you die. The third one is there's an annuity, but with the return of the principal you paid as well. So when you die, your heirs get the principal back, the original amount you'd invested. Obviously, the annuity number will be smaller if your heirs get back the money. Right? Now, these have been classic forms of annuities. And they actually date back all the way to the Roman Empire. So in this particular case, in the Roman Empire, people had already calculated how long people were able to live over a long period of time. So they said a Roman citizen already made the age of 35 could decently expect to live for another 20 years. Unfortunately, the problem was the people who actually bought annuities in the Roman Empire were likely to be different from the general population. And this most people did not realize until reasonably recently. What does that mean? Well, let's take why these annuities happen. Well, one reason is, at that time, the church believed it was basically bad. It was usurious to charge interest on loans. The reason, again, is because, remember, what finance is doing. It's moving money across time. That means we are placing a value on time. And the church's position was, only God can value time. Human beings putting a dollar amount or a pound amount on time, that's sacrilege. So they said, you cannot impose more than a certain interest level. For example, in England, the maximum interest rate on loans was 5% in 1714. You couldn't do more than that. But annuities could get around this. Why? Because you're saying, I don't know the final date. The person could die next year. They could die 20 years from now. They could die 30 years from now. So there is no final payment. We don't know when it's going to happen. So this is not really a loan. So you can get around the whole idea of charging a high interest rate on loans by providing annuities instead. And annuities took off like dramatically. It was not just people who were issuing annuities. It was countries. For example, the Dutch issued annuities to wage war on France in 1554. England issued annuities to finance its wars with France. France sold annuities to launch its war on the Dutch, and a whole bunch of other European nations in the 9 Years' War. Right? In fact, there is a story that Louis XIV went on an annuity finance spending binge, and there's some people who believe that's what led to the French Revolution. Right? It's like the country was pretty much bankrupt at that time. So, but why was this short-sighted? Well, it was short-sighted because at that time, nobody knew what an annuity was. You could buy an annuity whose payout was determined by the life of any nominee you wanted. You could say, if that person dies, I want my annuity payment now. So who do you pick, right? So basically, you want a long-lived person, right? So you keep getting money till the person dies, right? So who do you pick? Well, you could pick your granddaughter, or maybe your grandmother. It doesn't matter, right? Or you could pick your neighbor's grandmother. You could literally pick any stranger living a tranquil, stress-free life in a quiet village whom we thought was a good chance of living for a very long period of time. And, of course, people took advantage of this. For example, it turns out in Amsterdam, in the late 1500s, more than 50% of the nominees were under 10 years old. People bought annuities on their basis. They would have to get payment till they eventually died. More than 80% were younger than 20 years old. France had age-independent rente viagère, and that basically said they were primarily girls between the age of 5 and 10 with very healthy parents. You take out an annuity policy on their name. And of course, you want to make sure that they've all survived smallpox, because smallpox was the biggest killer at that time. So these girls have survived smallpox, not a problem. And then what do? You want to make sure they live for a long period of time, because they keep getting the annuity. So you take them to Geneva, where, the air is nice, it keeps them healthy, and the bankers can watch them. They're not doing anything dangerous, right? You don't want them to do anything dangerous. But of course, the issuers learned about this, so they started changing their policies. In Amsterdam, in 1672, it turns if you have a young nominee, the payouts are much smaller, because they know they have to pay for a longer period of time. Women are more likely to survive than men. So in England, when annuities were issued in 1829, there were lower annuity payouts for younger nominees and for women. Okay, so they said, okay, we need to find older nominees. The problem, of course, is the annuities had higher payouts for old men. If they survived 2 years, the investor would get back the initial stake plus 34%. That's a very nice return on your investment. If you survive for 3 years, you double your stake. That's amazing. That's like something like 35% return. It's great. Now, who are the healthiest old people around? Well, the story was in England at that time, it was Scotland. So what you do is you go to Scotland, you find some old geezer living in the locks, he's very nice, you take him and you pick an insurance policy in his name. One investor actually hired a doctor on retainer for paying him 25 guineas a year. Just only job, keep this guy alive, so that he would get the annuity as long as he could. But Even with that, they hadn't learned enough. So in 1829 again, they started saying, okay, let's figure out how long these people are going to live. Are they going to live for 5 years? Are they going to live for 10 years? How long are they going to live? So what they did was they went back to history. They said, well, how long did young people who bought an annuity a century ago, how long did they live after buying the annuity? Well, it turns out the problem was obviously survivorship bias. Specifically, one of the problems was life expectancy was increasing over time. So 100 years ago, whatever statistics you got had absolutely no relevance to 1829. Right? So they were pricing the annuities too low. Fine. Scientists jumped into the fray. For example, we all heard of Halley's Comet. But what we don't know is that before Halley actually talked about Halley's Comet, in 1693 he actually did the first systematic annuity calculations in one town in Breslau. And what he did was to collect birth and death tables for the entire city, exactly when people were born, when they died, and use that to predict when people would be likely to live and die. And he wrote a book chapter called An Estimate of the Degrees of Mortality of Mankind. What was the problem? Problem was very complicated. It was a thick book, lots of tables, nobody could understand it. So other mathematicians jumped in. De Moivre jumped in 1725. He was the guy whom we all read about when we do mathematics classes on imaginary numbers and things like that, De Moivre's theorem, but he also worked on annuities. All those things ignored the fact of selection. So today, what happens? You cannot buy annuities on other people's heads. Right? So that's illegal. Fine. Or can you? Well, let's take an example. These are what we call life settlement policies. And this is totally legal. So what is this policy? The policy is something like a company called Coventry, which will buy your life insurance policy from you. So what they are doing is, so in this particular case, this is a retiring CEO. He gets an $11 million term policy from his company, and he doesn't need the life insurance policy, so he sells it to Coventry First, and Coventry First gives him $2.75 million. And so he uses that to set up a trust for his heirs, but, that way he can get things. So what happens is, as part of the policy, the company will keep making the premiums, and you're fine, right? When you die, they will collect the premiums from you. Fine. There are problems here. The biggest problem, of course, is you need to know when the guy dies, right? So you have to keep close track of him. So every month you call him up and saying, how are you feeling? Are you feeling okay? And if he says yes, you're like, shit, right? But you're hoping that he dies quickly. But this is not illegal. Why? It's because the policy was not purchased for the purpose of selling it to somebody else. It wasn't started as a financial instrument. You bought it for life insurance, and then circumstances changed, so you've sold it. That's legal. What is not legal is something called STOLI. So what's happened here was, Coventry First and all these other cases, there's a demand from investors for this kind of policy. But there's not enough supply, because most people do not sell their life insurance policies. So there is a new policy called stranger-originated life insurance. And what that means is, essentially, you take out a new life insurance policy specifically to sell it to your investors. Okay? So what is the structure? You create a trust. The investor, the person who's paying the premiums, is the beneficiary of the trust. And the investor will keep making the premium payments and compensate the policyholder for arranging the policy. This is illegal because, as you said, this is being created for the express purpose of a financial instrument. But why is it illegal? It's pretty much the same thing. I took out an insurance policy, circumstances changed, I sell the policy. But I'm taking out a policy for the purpose of selling it to an investor. That's illegal. Why? Well, part of the reason is the insurance company, and companies, by the way, have got into all sorts of trouble. For example, Apollo Global Management acquired illegal life insurance policy and funneled the payout to shell entities. So they were basically doing exactly this, and they got caught. And they have been sued for that. Right? But anyway, the story part comes in because the insurance company knows that a certain percentage of their customers will never cash in their life insurance policy. They run out of money. They have no money to pay the premiums. So they've taken out the policy, but up to 38% of them will just lapse. So the insurance company never has to make the payout. But if you have a professional investor on the other side, you can guarantee that guy will make the payment month after month after month. Right? These guys are finance experts. They're not going to let the policy lapse. So they're pricing the policies too cheaply. That's the idea here. That's why the insurance companies all agitated to get rid of making story basically illegal. So anyway, today, insurance companies try their best to avoid this problem of customers lying to them. What do? If you think, for example, of the UK pension, right? In the UK, it used to be the case that you could take up to 25% of your pension pot tax-free, right? Now, you could use the rest of your pot to buy an annuity that guarantees an income for the rest of your life, no matter how you live. You can also get a guaranteed income for a fixed period, all those things I talked about earlier. And at that time, you could not change your mind. Once you bought the annuity, it's gone, right? You can't change your mind later. And the reason, of course, is because if you change your mind later, you know about new information, and therefore you will be select into a market where you know more information than the company does. But the question is this a good thing to do? And this is something that a lot of us would care about, right? We are about to get a pension. Should we buy an annuity? Now, it turns out, before 2015, it was mandatory. You had to buy the annuity, and about 90% of pension plans were converted to annuities. But in 2015, there was the Pension Freedoms Act, which was passed here in the UK, and it removed the requirement to purchase the annuities and allowed people more flexibility in accessing their pension savings. What happened? First thing that happened, people stopped buying annuities. The number of annuities purchased was 189,000 in 2014, the last year before it became freely available, it became flexible. And in 2019, less than 49,000 annuities were purchased. So a better question to ask is now how popular are annuities? Is that how unpopular are annuities, and why are they unpopular? Well, the key part is, number one, how do the insurance companies actually give you this annuity? They have to take your premiums and they have to invest the premium and use that money to eventually pay you the annuity. The problem was, historically low interest rates meant that they couldn't pay you that much money. So, for example, if you had a £100,000 pension pot, you get about £5,000 annual income during that low rate period. So most people said, wait a minute, I'm giving up £100,000 for £5,000 per year till I die? I don't know when I'm going to die. A lot of people said, I don't want this. And of course, people are living longer and longer, so they said the amounts kept dropping. Now, by the way, today, higher interest rates in the last 2023, annuities became slightly more popular, but not hugely more popular. If you look at today, for example, the red point there is a percentage of pension pots are converted to annuities. You can see how tiny that is. The smaller the pension pot, the less likely you are to use an annuity. Right? Almost nobody buys an annuity. So what that essentially means, if there's no market and it's not mandatory, only a few people will buy annuities, and the market is biased against the providers. So the providers say, this is not a profitable business. They dropped out. So what we see is the provider numbers decreased from 25 in 2016 to about 5 open market providers in 2021. Only 4 providers now offer annuities to people over 75. Right? And the average pot sizes have increased from 37,000 you needed for an annuity, now you have to have about 71,000 pounds for an annuity. All of this becomes a vicious circle. Annuities become less profitable. Annuity providers drop out, which means essentially the market unravels over time. So why are annuities not more popular? Well, this is something called the Annuity Puzzle. Right? From a finance perspective, we're thinking, why would more people not buy annuities? A paper's written about this. For example, one of the top journals in economics, called the American Economic Review, talks about the Annuity Puzzle. And they say, okay, you know what? It's possibly some kind of psychological or behavioral bias. We don't know what this is, but people are weird, essentially. So part of the reason is many people hate the idea that tie up all the savings in an annuity, then die too soon and not leave anything to your kids. They call that a bias. And the other major problem is, of course, if the key people who are buying the stuff are elderly people. Right? They're the only people who are really interested in pensions and annuities. And if you target them, then you're likely to be prone to lots of scams going on. Take an example. This is from the New York Times. So where an annuity pitch was sent out to people saying, invest in our annuity and we'll give you a free steak dinner, complimentary gourmet meal featuring New York steak. So this guy went to it, and it turns out this guy was an insurance salesman who had been the subject of a state cease and refrain order because he was selling products which were totally unsuitable for the people who the products were meant for. But in that one, he gave a graph. And that graph has on there a blue line. The blue line is supposed to mark how the annuity is paying out over time. Notice how steady it is. So basically he was saying, you buy an annuity. Don't worry about the red line. The red line is how the market is doing. Sometimes you'll do better, sometimes you'll do worse, but the annuity will give you the same money month after month after month. You have a stable and safe source of income. What they didn't mention was if you look at the graph very, very carefully, the red line does not include dividends. So the companies which you're investing in the market are paying dividends. You add the dividends to the red line, it goes way above the blue line. So essentially, but can you read that? I couldn't, right? Even if you look at the original, my eyes are not getting much better, but even I couldn't read what the hell it was talking about in the fine print. Anyway, the problem here is essentially that annuities targeted towards older people are always viewed with skepticism by the government. Right? So these guys, they're targeting a group of people who are vulnerable. Are they really interesting products? But there's also a selection reason. We do have data on life expectancies. For example, you can look at the United States. This is the Social Security areas. And you can get table after table telling you exactly when people are going to die. For example, that's the age-adjusted central death rates by sex under age 65 and over, by calendar year, male age-adjusted rates, they're all death rates. Right? Literally, you can get them anywhere. But we don't want data on the general population. We want data on the people who want to buy this kind of insurance. Well, we have that data too. Well, this is across the world. This is the Society of Actuaries. In the US, they have basic tables. It doesn't matter. You want the UK, they have data tables called the Northampton table, population data of Northampton, United Kingdom, basically age of death, minimum age, maximum age, everything. Literally every part of the world, they will tell you when people are going to die. This is phenomenal, right? You can get this data, and you can say, I know when people who are buying annuities are going to die, so I can price the annuity appropriately. Not really. This is another table which shows you, this is the first line there, is the first column there is, what is the probability that you're going to die within a year of that age? So 65, and you see the number 0.0152. That means 1.52% of the people will die after the age of 65, between 65 and 70. The next line over here, the next column, are the number of people who die after having taken out an annuity. Remember, the annuity was as long as they live. The answer is 0.008. So it's like half 0.152. People who take out annuities know they're going to live longer than the insurance company knows. What is it that they know? We don't know. The insurance company doesn't know. It just is. Somehow, these guys, and it doesn't matter what you look for. If you have a 65-year-old man, your one-year mortality rate is half that of a 65 general male population. If you look at a 95-year-old male, that's 1/4 what a guy who's not taking an annuity is. Healthier people who know they're healthy for reasons the insurance company doesn't know about, are much more likely to take out annuities than the general population. So the problem that means is insurers always have a problem with the price. But they're trying to figure out, how do we price this? How do we know who's going to die? We need to know that information. But these guys apparently have better information than the insurance company does. So they always make mistakes with the price. Sometimes they price it too cheaply. Let's take an example. This is private insurance for unemployment. The idea is you keep making the insurance payments, and if you get fired, they will pay you till you get for 2 years or until you get another job. Right? So unfortunately, this article was written in 2009. And what happened to this product? Did not work. Nobody was buying this. Actually, people bought it like crazy, but the companies went bankrupt. Why? Well, the companies put into place all sorts of things. For example, they said, pay $69.95 a month. And if you lost your job through no fault of your own, you get $1,500 a month for 6 months. Right? But, key part, you couldn't collect on the policy until you had coverage for at least 4 months. That means you can't collect. That means if you think you're going to be fired at 8:30, you figure out you're going to be fired at 12, you buy insurance at 11 o'clock. And then, you're happy, you got insurance, right? So they wanted to stop that. So it was like, okay, you need to tell us, you need to buy the insurance policy 4 months. And they said nobody's going to be able to predict 4 months ahead whether they're going to be fired or not. They were able to predict 4 months ahead whether they're going to be fired or not. So lots of people were buying this policy. It failed. 2009. Well, 2016, they said, we'll do it again. A different company called Income Assure. And they made the conditions more stringent. This one basically said, 6 months. You cannot collect a check covering your gap of pay if you lose your job within 6 months of signing up for the insurance. And the CEO, David Sterling, said, anyone who knows they're going to be laid off after 6 months, I'm happy to sell them an insurance policy. Well, this was an article from Reddit. The people were discussing this and other things. So here's an example of somebody who said, has anyone actually used Income Assure and received benefits from it? I work for a major company, moving a lot of operations to different regions. I think I'm going to get fired 1 year from now. Right? Not 6 months from now, 1 year from now. And this guy says, wait, this is I'm 99% sure we're going to be impacted within a year. So is there something wrong with these policy guys? It seems too good to be true. Unfortunately, a lot of these guys existed. So even 1 year wasn't enough. This company failed as well. Okay? So some people said, okay, let's price it. Other companies have priced it cheaply, but for a different reason. Example, taxi insurance. So it turns out American Transit Insurance Company is not a household name, but a New York taxi cab will be insured by American Transit. It insures about 60% of all the commercial taxis, livery cab, black cars, rideshare vehicle, completely. It's also bankrupt. Why is it bankrupt? Well, it sold insurance too cheaply. But why did it sell insurance too cheaply? Answer is because they wanted market share. So it underpriced everybody else, cut everybody else out of the business, and once that happened, they became too big to fail. So if they went bankrupt, the state would have to step in and provide insurance for everybody. And the state didn't have, basically, these guys are getting money from the government because they priced it cheaply for a deliberate reason. They wanted to get a lot of bonuses, which they did get, by the way. All right, sometimes they price it too high. Let's take an example here, divorce insurance. So when you get married, at the moment you get married, you can take out insurance so that you get paid if you get divorced. Why do you want that payment? Presumably to pay off your lawyers, right? So this is ahead of time. Now, of course, there's obviously a selection issue here because you're buying the insurance before you get married. It's a sign that maybe, you don't expect your marriage to last that long. So how did this company solve that problem? Well, it turns out, in this particular case, each unit cost $15 per month and provide $12.15 coverage. So you bought 10 units, your initial coverage was $12,500, and you're paying $15.99 for each of those units, and so on and so forth. But the key part is, you cannot get this until you have coverage for at least 4 years. Okay, so that means, in other words, if you get divorced before 4 years, the company will not basically pay you anything. You have to get divorced at least after 4 years. The idea is nobody can predict, okay, I'm going to get divorced 4 years and 1 month from now. That's the basic idea. Unfortunately, this company also failed. Why? Not because the insurance was too cheap, but because it was too expensive. Let's think about what it actually means. Right? So remember, this is 48 months you have to pay premium before you get the money back. Well, the insurance premium is $1,900 a year here. You gives up about $12,500 to cover the cost of a divorce. The maximum payout by the policy increases by $2,500 for each year a couple stays together after 4 years, but you still have to keep paying the $1,900 a year. And if you divorce after 10 years, for example, you get $27,500, which is more than enough to pay your lawyers. Unfortunately, you've also paid $19,000 in premiums over that time. If you had invested that $19,000 in the stock market or whatever, you would have had much more than $27,500. The insurance policy was too expensive. Right? Okay. Sometimes, though, people paid anyway. Example, pet insurance. And this was a case where a company where this dog called Buffy. Apparently, Jack Stephens was a veterinarian. He met a client and his daughter, and he said the dog had died. The guy had euthanized the dog. And the client said to her daughter, honey, you remember Dr. Stephens, don't you? And the little girl said, yeah, he's the guy who killed my dog. Right? And so he said, you do not have to kill your dog. Buy insurance, and we will keep your dog healthy as long as you live. Unfortunately, this is a super high price you have to pay for keeping your dog healthy. Why? Turns out, if it's a 15-year-old Dachshund, it costs $650 a month to insure the Dachshund. Policy covers 70% of medical costs. Annual payment cap is $15,000. They will not pay you more than $15,000 if your dog dies, to keep your dog alive. Routine care, totally excluded. So insurance costs basically $8,000 per year, but doesn't pay out more than $15,000 annually. But people buy it anyway. Right? This is a part of your family. So a lot of people are buying this. It's costing immense amounts of money for very little payout from the insurance company. Possibly one of the reasons why I don't have any pets. Right? Too expensive. What about life insurance? So what we have talked about so far is if you live too long, the insurance company has to keep paying till you die. But this one is a different thing. This one is, if I die, the insurance company will pay me. Okay? So classic example was in the late 1500s, a person called Richard Martin purchased a life insurance policy for £30 that would pay £383 if William Gibbons, totally different person, died within a year. Great. The policy was underwritten by 16 investors, each paying £25 to £50 for the potential payout. Okay? Very nicely, the contract started on 18th June, and Gibbons died on May 29, 1584, just weeks before the contract expired. Did he die, or was he? No. The insurance company said, no, we're not going to pay. Why? They said, we calculate by 28-day, 4 weeks in a month. And if you take 4 weeks in a month, this is more than a year, so we don't have to pay anything. So Richard Martin went to court, the insurers lost, and he made a 1,250% return on his initial investment. That's not all, though. It turns out in 1622, there's a 90-year-old master of the mint who bought a 300-pound life insurance policy for 75 pounds. And they died within the year, and the insurers paid the full amount in this case. But the twist in the story is that the man's name was Richard Martin. And some people speculate he's the same Richard Martin who made a killing, literally, in the case of the previous example. We don't know. Anyway, but more recently, if you guys have been keeping up with Netflix, there is a series on Netflix called Monsters, which is the Lyle and Eric Menendez story, which is a pair of kids, basically, who murdered their parents, and no one suspected them of actually murdering their parents until the younger Mr. Menendez, over there, actually wrote a screenplay where someone murders their parents for a life insurance policy. I mean, I'm like, sometimes you wonder about why people do these things. But then the police said, wait a minute. They read the screenplay. They arrested these two, and they went to jail. But anyway, they got an insurance payout of $650,000 because at that time, nobody suspected they had murdered their parents for the insurance policy. Anyway, but life insurance has become much, much more sophisticated since then. Today, for example, in 1706, if you wanted to have the Amicable Society of Perpetual Assurance Office, there were 2,000 individuals who became members of that society. You paid an annual premium of £6 and 4 shillings per share, up to 3 shares allowed per member. And the idea was the beneficiaries get payouts of £150 per share. And the primary purpose, provide financial support to families after the death of a breadwinner. But how does the insurance company know whether you're going to die quickly or not? Here, you're trying to make sure the guy stays alive as long as they can. Well, it turns out the eligibility was limited to individuals aged 12 to 55 to avoid the oldsters. Right? You cannot buy this kind of insurance then. In addition, the directors personally inspected all the members to make sure they were not sick or infirm. And if you were not living in London at that time, you could provide a reference letter attesting to your health and sobriety. But again, this may not necessarily be sophisticated enough. For example, this is a paper which talked about the life insurance market, and they looked for survivorship bias by looking at people who were just about to buy insurance. And so this is basically all the people who are buying insurance or not at the beginning, not the people who already bought insurance versus the people who did not buy insurance. That's, as we said, a sample that does not work very well. Anyway, it turns out that even if you look at this sample, individuals who died within a 12-year time window after the base year were 19% more likely to have taken up life insurance in the base year than those who survived that time window. That means there was something, again, that the people who were dying, previous example we saw, the people who were living knew more about themselves than the insurance company. The people who are likely to be dying also know more about themselves than the insurance company. So people know more about themselves. Companies don't know enough. And that's what causes all these policies to be priced so weirdly. So how is this happening? Are the customers lying about it? If you think about it, insurance is kind of weird, right? If you apply for insurance, for example, people might be tempted to lie about their lifestyle. They say, look, we're healthy non-smokers, right? And if you buy an insurance policy, they don't verify your details. You just type in whatever you want, right? We've all bought insurance, car insurance, house insurance. Are you a good driver? Have you had any accidents over the last 3 years, the last 5 years, whatever, right? You don't report it? Fine. They're not going to check. Why not? Because they don't need to. What they do is they check it after you claim. So if you claim and they find the information is false or misleading, they will immediately deny coverage. Right? So if you remember, there's a very famous play, Death of a Salesman, right? Classic play, where Willie Loman basically decides he wants to commit suicide because he says, I've been paying insurance all my life, so why don't I commit suicide? That way my family will get my insurance policy. But of course, the point is, if you do that, today, the insurer would have taken that into account. For example, if you do things like scuba diving, bungee jumping, or hang gliding, no insurance policy for you. right? Work or vacation plans with civil interest or high crime, they inquire about your international travel. No life insurance for you. Driving habits are scrutinized. Your speeding tickets, if you're drunk driving records, all no insurance. Right? So very, very careful about checking for all this. What about car insurance? This was an example I've used in the past called Root, where you download an app on your phone before applying for insurance. And the app tells the insurer everything about your driving, whether you're driving too fast, whether you're braking too hard, whether you're turning too fast, whether you're going through red lights, everything. And they say it really affects your insurance rate. The better of a driver you are, based on the app, the lower will be the price. And so it says, you drive around like you would for a few weeks, and you get a low insurance policy. Fine. If you're a bad driver, they will not give you insurance. They don't call you a bad driver. They just say, you know what? Our models don't work with every situation. So not that you're a bad driver, it's just our model is not working. But sorry, go and find insurance somewhere else. Unfortunately, the problem is, the moment something like this happens, all the good drivers are creamed off by Root, and all the bad drivers go somewhere else. So what does the other insurance company do? It has to raise its prices because it only has bad drivers now, which means that the less bad drivers go somewhere else, which means it gets even worse drivers. So the only way to survive is that everybody does this. Right? So everybody is now trying to use apps for this kind of stuff. It is your age, zip code, record of prior accidents, and so on and so forth. But it will also look at everything. For example, do not drive between 4 p.m. and 8 p.m. In the spring and summer, between 8 p.m. and midnight. You look at your annual mileage. Look at when the sun is setting or actually set. These are the peak timings when the insurance company will say, okay, this is dangerous. This guy might have an accident, so we'll change your rates at that time. And we look at, be careful of quick acceleration, fast stops, or maximum of 10 miles and over the speed limit. And I'm sure a lot of you think about that when you're driving on the M11. Right? If you can, go 10 miles over the speed limit on the M11. All right, probably not. But if you do that, State Farm mobile app will do it when you're 8 miles over the speed limit. So your insurance company is watching what you do. And distracted driving, if you check your phone while you're driving, remember the app is focusing on when you're doing it. If you check your phone, your insurance policy rates go up. So a lot of people are saying, do not do this. Right? Don't give these guys all this information. For example, you street park at your girlfriend's house on the weekend in a high crime area, well, your rates go up. You drive past a bar between 4 p.m. and 8 p.m., your insurance policy rates will go up. So these are the kind of things which will happen. And some people cannot get insurance at any price. So another paper written on that was looking at what gets people to be refused insurance. And we think this is uncommon, right? We can buy insurance. Turns out that's not true. What triggers rejection? If you have a past stroke, you're automatically rejected for life and long-term care insurance. If you have previous nursing home residency, you're rejected for long-term care. If you have conditional acceptance for cancer, if the treatment ended 4 years prior. If you have ongoing weight loss, is ground for rejection, but they are fuzzy about the criteria. It turns out 30% are ineligible for long-term care insurance. 20% are ineligible for life insurance. Basically, rejection is common for individuals over 55. It's not rare. If you're over 55, insurance companies will say, sorry, you're too high a risk. I'm not going to insure you. But maybe they can make you better human beings. How is that possible? Well, it turns out that Joseph Stiglitz, when he gave a Nobel lecture, he talked about this insurance company which based its office on the top floor of a walk-up building with no elevator. The idea was, if you are healthy enough to go to the top floor, you're healthy enough to get insurance. Apart from the story, we don't really know if it's true, but the idea is some insurance companies offer to throw in free or subsidized health membership. Basically, they say, if you go there, we'll give you free health membership, health club membership. Okay? And they describe the offer as a way to make it easier for the customers to stay fit and thus out of the doctor's office. Okay? Well, do people really change their behavior? Well, if you think about, free gym membership, sign me up. The answer is not really true. Who is attracted to the gym membership? People who are never going to exercise are never going to exercise. The people who are attracted to that membership are people who are already healthy, who like going to the gym. So I'm separating out the healthy people who like exercising, and I'm giving them insurance, cheaper insurance, than the unhealthy people who are never going to exercise anyway. Nobody, and if you're unhealthy, buys a policy just because it's giving you a free gym membership. You're never going to use it anyway. So this was a paper published in the New England Journal of Medicine, which looked at exactly this. They said the healthy people are the ones who have lower medical expenditure and healthier behaviors. So I'm screening out the people who are already likely to go to the gym, precisely my kind of customers. I don't want unhealthy people, and they are the ones who will not go. Okay, maybe another way to do this is to really make life difficult for your customers. What can you do? Exclusions and fine print. So what can be excluded? For example, suicide. Willie Loman's example was all about suicide. Or high-priced medications, right? So I'll pay for medication, but it's too high-priced, I'm not going to pay for it. Similarly, known expensive repairs in your homeowner's insurance. Or the fine print, right? If you have a lot of fine print, I can find some reason to deny you coverage for anything. I'm just trying to make sure that you do not claim after the fact, right? Okay, or you can just make them wait. Suicide waiting periods, 1 to 2 years. You cannot buy a life insurance policy and then commit suicide the next day. You can commit suicide, but do that at least 2 years after you bought the policy. So in principle, Willie Loman would have been okay. Would not have been okay because he would have committed suicide, which he did. But, so he probably did get an insurance payout. I always wondered. Right? So when you read Death of a Salesman, figure out whether he got paid by the insurance company or not. Anyway, there are general waiting periods if you're aware of imminent death by suicide, by natural causes, and so on. Policy representation, your heart conditions or family history, it voids coverage. Bungee jumping, skydiving. Death during illegal activities, if you rob a bank, sorry, there's no coverage for you. Right? So you can't take an insurance policy and then go and rob a bank and then get killed in the process. Other thing, dental insurance. You buy dental insurance, preventive care, they cover immediately. But basic procedure like cavities, 3 to 6 month waiting period. So if you're in agonizing pain, you cannot buy dental insurance and then get the cavities checked. You'll have to buy it 3 to 6 months ahead of time. And if you have major dental work, you have to wait up to a year before you get coverage for those policies. Pet health insurance, waiting period for injuries, 1 to 2 weeks. That means after a car accident, you can't immediately get coverage for your pet. You have to wait at least 2 weeks. Right? Hopefully, you're not going to think about this at that time, but this is the idea there. Right? If you have hereditary or congenital conditions, the longer waiting periods, again up to a year. Or human health insurance. In America, if you're working for a company, you can only sign up for insurance once a year. In October. They have what they call open enrollment policies. So you sign up only in that 1 month can you sign up for a policy. You cannot sign up at any other time. Why? Prevent selection, right? If you think, oh, I need health care, I'm going to sign up for the most expensive policy at the time when I need it. But if I can only do this in October and I cannot change it to the next year, I will not necessarily pick the best policy. I just pick the policy which I can afford at that time. Non-selection markets are in the UK, but they have different consequences. The key here is the costs and the benefits are dissociated. We do not know how much it's costing us. Right? We know that we are paying for this, national insurance, all these other things we pay with our taxes, but the care we get from NHS is different from the costs we pay through our taxes. So we don't know how expensive these things are. What is the consequence? The demand is too high. Right? And we've all seen that on NHS waiting lists, and in the absence of adequate funding, what you have is rationing. That's why we all have experienced super long waiting lists at the NHS. Right? It's something simply caused by the fact that we don't know how much it's going to cost when we actually do this. And of course, there's lots of schemes to increase productivity. In the early 2000s, doctors were got paid more if they responded to their patients within 48 hours. What consequence did that have? Well, if the doctor couldn't see you in 48 hours, they would not see you. Right? So you have to call them at 8 o'clock in the morning, wait on the thing, and just get in that 48-hour window. Otherwise, tough luck, you call back again the next day, and you call back again the next day. Some of you in the audience will be very familiar with that. Right? Or you pay doctors for success in treatments. Would that work? Well, in that case, if I couldn't treat you, I don't want you as a patient. I only want you as a patient if I think I can succeed in treating you. So overall, to conclude, what this is basically saying is selection markets are fascinating. Right? Everything is all about people lying to each other. So the question is, can I make you tell me the truth? Can I make the company tell me the truth? All these things are the essence of selection markets. So one guy who really, really appreciated selection markets, Franz Kafka. So Kafka actually worked for the Austrian Workmen's Accident Insurance Institute. And before he wrote his books, he found the concept of insurance captivating, despite finding his specific job too dreary. Right? And his experience in the insurance industry reinforces perception of bureaucracy as a system of pointless rules run by petty autocrats. So today, when you're thinking about the frustrations you face when dealing with your rejected insurance claims, maybe you think of Kafka and how fascinating this whole world of insurance is. Okay? And that's it. Thank you.